Let's talk private credit. Much happening in the space. ASIC Chairman Joe Longo highlighting a lack of transparency in private markets compared to public and saying the regulator has decided to make it a priority over the next 12 months. For an outlook on the private credit space, Chris Andrews, CEO of La Trobe Financial, joins me now in studio. Seemed like some pretty fighting words from the ASIC Chairman. What do you make of it?
It's an interesting time, Juliette. What we've seen over the last 2, 3, 4 years is a proliferation of these corporate-facing private credit operations. They've been, in many ways, really successful in raising funds, but of course, as a new sector starts to flourish, it is sensible for the regulator just to take a look, and they'll be looking at things like valuation practices, transparency as to the performance of assets, things like hidden incentives that might be in fee structures, related party transactions, etc. And I think, for all of us, that's a good thing for any sector.
All right, what are you seeing in terms of the major themes at the moment in private credit?
Yeah, well, for us, we've been in real estate private credit for over 70 years, Juliette. So whilst there is a lot of activity in the sector, for us, it's something we've been focused on for more than 7 decades. So what we're seeing is a lot of interest from investors who are starting to realise the power of private markets and the role that they can play in portfolios. Subject to those caveats that it does have to be an experienced team. You do want really good transparency as to how the manager's operating. But we're seeing lots of interest from investors, from financial advisors, really across the spectrum in what we're delivering for portfolios.
And a lot of demand as well?
Yeah, huge demand. So we're deploying about $1 billion of capital a month. And what we're seeing is a really good flow of residential and commercial mortgage-based assets. We always take a senior position, so that's where we play in the market, but we're seeing huge demand for those sorts of investment strategies.
We know, because it's so easy to track what happens in public markets when you have a big event like the drama, I guess, you're seeing unfold in Washington. How does it sort of play out more in private markets, and how are you monitoring geopolitical risks?
Yeah, so certainly you should expect to be able to track the same things in private markets. And to anyone who's a private market investor, if you feel like you're not getting a full picture for what's going on, that is a red flag. And those are the sorts of issues that ASIC is reflecting on, rightly, in our view. What are the big issues at the moment? Probably the biggest issue is that there has been a wall of negative, or at least volatile news coming out across the world geopolitically, in markets, etc. And public markets, at least, have been reacting with an extraordinary degree of calmness. And honestly, every investor should be asking themselves whether that calmness is well-founded, or whether we should be taking a little bit more cautious approach to what might be happening in the world across the next 3 years.
So if you do see red flags, how does one sort of pick an asset manager?
So when you're picking an asset manager, you want to look for experience. You want to look for, if you're talking about in our space, private capital, the easiest thing in the world is to lend money. It's not so easy to get it back, particularly when times are difficult. So you want to see that your manager's got that track record, not just when times are good and calm, but also in difficult times. And then for an investor, what you want to see is diversification. When the world is volatile, really at any point, but particularly when the world is volatile, diversification is the absolute pillar to building a sound, robust portfolio. What
sort of diversification are you looking at most closely at the moment, given there's also a lot in terms of alternative assets too?
So, thinking about how we instantiate that into our portfolios, we don't take big swings. So, our flagship strategy, we've got over 8,500 individual exposures in that strategy. So you can see it's a very diversified approach that we take. For an investor, it's being diversified across asset classes. You do know that in a time of real crisis, all correlations turn to one, but your safest bet as an investor is absolutely to take a very diversified spread across equity positions, across private credit positions, across the debt stack. Traditionally here in Australia, it's fair to say most conventional analyses would have said that Australian investors are overexposed to equities. So you absolutely do need to think about that as we head into a period of uncertainty.
I was just speaking to a previous guest earlier saying 60-40, which has been said quite a bit, is completely dead. What is the sort of sustainable way forward in terms of investing and making sure that you are, to your point, heavily diversified?
Yeah, if there were an easy rule of thumb, Juliette, everyone would do it and it would be easy. There are all sorts of, conventional rules of thumbs that you can apply, such as subtract your age from 80%, etc., for your exposure to equities. The real thing that investors need to be reflecting on is the issue of sequencing risk. As you approach retirement age, you are generating peak wealth, if you like, in your portfolio, which means you've got most at stake to lose if markets correct. On the other side of the equation, you don't have a long horizon ahead of you to make that money back or for money to recover. So what you should be doing as you approach retirement is transitioning from high growth, higher risk, equity type investments into safer, fixed interest, more conservative approaches.
What are you seeing at La Trobe Financial more broadly on the overall macroeconomic picture? How, I guess, Australia is faring when we could be seeing a rate hike at the same time that other developed nations are cutting?
Yeah, so certainly it's our view that rates stay higher for longer. That's been our view for some time, Juliette, and there's a whole range of reasons for that. And, broadly speaking, the Reserve Bank will be very dependent on the data, but we've got a new governor and she does need to plant the flag as a strong fighter of inflation. So that's the first thing. In terms of what we're seeing, honestly, we're seeing a whole lot of robustness in the Australian borrower, a surprising degree. Remember, we've had, 4.25 percentage points of increase in official cash rates, and honestly, our borrowers absorb that without missing a beat. So that degree of robustness, which I think has manifested really across the economy, has been surprising, and is part of the legacy of 30 years of consistent economic growth. So what would I say to that? We can't as a nation take our eye off the ball of the big issues, and the big issue in the long run remains productivity. So in the short term we'll look at an inflation, we'll watch unemployment, we'll be very focused on what happens with interest rates, but in the long term, whether we get another interest rate increase or two, or whether it starts to tail off, that's not going to be a huge driver of genuine wealth generation for our economy in the long term. We must focus back on productivity, and that's where we're still lagging.